Hello, everyone, and welcome to today's webinar on 5 financial strategies for lawyers' unique circumstances. My name is Rick Gosen. I do business development at Nicola Wealth. I will be presenting today along with my colleague, Ron Hake, Senior Financial Advisor. All right, so let's get started with the presentation. As I mentioned, the title is 5 Financial Strategies for Lawyers' Unique Circumstances. Ron, next slide, please. So the question would be, are lawyers actually unique? Well, unique in which way? Now, there's many lawyers that we might say are unique from a personality standpoint, but are they actually unique in terms of their financial situation? Well, so here's an example of a lawyer. Now, I might say this fellow reminds me of some of the people I went to law school with, but I won't say that because there's actually people from law school who are who are watching this presentation. But in any event, this is actually a real lawyer based in Europe. Anyways, this is a unique fellow, but we're talking about unique financial circumstances. So having a presentation like we are, which deals with financial strategies and referring to lawyers as unique, well, are they actually unique? So I would say no and yes. So they're not unique in the sense that lawyers are like many other professionals, highly trained, they build their time, they might have professional, personal corporations, but so in some ways they're maybe not that different than doctors, dentists, engineers, and accountants. But at the same time, we would say, well, you know what, lawyers have some unique circumstances. Now, of course, the information we'll provide, the financial strategies, applies to many professionals. But what we'd highlight is we understand the unique circumstances of lawyers. So we believe there's 5 unique characteristics of lawyers that need to be kept in mind when doing financial strategizing for them. So I'll just go over those 5 really quickly. So first of all, there's a very long training period. In fact, the training period, there might be, if you think about it, a $1 million opportunity cost. Well, why do I say that? Do you imagine how much money you could make in a 10-year period? You know, for myself, I didn't really start earning money as a professional until I was in my late 20s. So for a lot of people, first they do an undergraduate degree, and maybe it's 4 years. If it's an honors degree, maybe 4.5. Many people I knew at law school, they actually had 2 degrees before they came to law school. So after their undergrad, then they go to law school. That's 3 years. Some programs like McGill dual degree program, that's 4 years. And then you have to do your year of articling. So we're talking 10 years of training. And you can imagine how much money you could have made in that 10-year period. So there's big opportunity cost. Secondly, the cost of education. I had lots of friends from law school who they came out of law school with a lot of debt. And that debt has only increased because, as we know, over the past few decades, a lot of law schools have moved to market rates for tuition. So when I went to law school, I paid the same as somebody doing an undergraduate degree in history. Well, that's changed significantly, as we all know. So law schools have moved to market rates. So the cost of getting that law degree is a lot more expensive. And that's something that people have to grapple with coming out of the gate. So it takes them a bit more time to get to the point where they're saving a lot of money and have it with the chance to reinvest. Thirdly, lifestyle norms and pressures. So projecting success. This is a really interesting issue because I think most lawyers are used to having a certain level of lifestyle in terms of cars they like to drive, clothes they like to wear, where they like to travel to, where they like to eat, all of which is fine. We all make choices, but that's unique to certain professions in terms of lifestyle expenses. You know, I've taught at universities as a part-time professor. Not a lot of professors are concerned about projecting a certain level of success or having a certain lifestyle. You know, you always get the joke about the professor wearing the same beat up tweed jacket for years on end. You know, they don't spend a lot of money on their wardrobe. So lifestyle pressures, that can be a big barrier to saving money. Fourthly, professions, especially law, can be extremely time consuming, meaning that there's not a lot of gas in the tank to be sorting out your own financial planning. So we find that from the professionals we work with that they're not really into the DIY, do it yourself. Some people, maybe if they work short hours, might have the bandwidth to do that. But for a lot of professionals that we work with, they're experts. They spend a lot of time becoming experts in a certain field. They want to deal with someone who can focus on their area of expertise, do a great job because they don't want to figure it out. Lastly, what I've discovered is a lot of lawyers are risk averse in life and finance. This may come from the fact that for a lot of lawyers, they constantly see what can go wrong. So we all know when you work in a law firm, you're constantly solving and sorting out people's problems, all these things that you didn't think could go wrong, and they actually do. So for a lot of lawyers, they get into this mentality of, avoiding risk or mitigating risk. So of course, that will impact the type of approach you take to your financial strategies. So what to do? So that's what we'll look at in this presentation. So I'm now pleased to hand over the reins to Ron Hake, Senior Financial Advisor, who has a lot of expertise dealing with professionals, and he'll explain the unique financial strategies for lawyers' circumstances. Ron?
Thanks, Rick, and thanks everyone for joining us today. What makes Nicola an expert in this space? A little background on us. We were founded in 1994. We're licensed across Canada, offices in BC and here in Ontario. We manage over $9 billion for about 2,400 families, and our focus is specifically individuals in this sort of scenario. We work with executives, we work with business owners and professionals, and we have 2 advisors on every file. And we start with planning first and foremost. I think that's certainly a unique differentiator, and certain asset classes that are only available to certain types of clients. And we'll touch upon each of these things today. So let's talk about planning. It's quite important to look at the 4 financial phases of a lawyer's career. When you are early in your career, you're just starting off. As Rick mentioned, maybe there's some low income, you've got some law school debt, your time is limited. Maybe you're combining dual incomes because you've gotten married, and you're determining what you can and cannot afford. Example, like home or kids, partnership track obligations. And so it's important to develop a financial plan that's investing in a tax efficient portfolio, saving for your retirement. Those are things that are part of what we look at. As a senior associate, you start to look at things like in saving for retirement, saving for your kids' secondary education. And as a partner, you're transitioning from employee to equity. Now it's about maximizing that income, the tax efficiency, minimizing the financial risks that Rick spoke of earlier, safeguarding against any unexpected liabilities. And you really now need to prioritize savings. So you've got retirement, kids' education, maybe a second home, charitable giving, and creating adequate liquidity to cover your expenses and taxes. Whoops, sorry. And as you move into the final stage, which is your post-law, we look at how do I monetize this practice value? What is the retirement income planning that goes with that? What's the estate planning? What's the philanthropy? What are the financial supports for your kids and grandkids? So there are a lot of moving parts. And when you start to look at the components of a financial strategy, it needs to be comprehensive, it needs to be tax effective, and it certainly needs to include insurance for income planning. And then finally, we want to look at cash flow because cash flow is always king. Now, why is this important? More today, I think, than in previous years. Because prior to COVID, the legal profession might have been largely unaffected. You just keep earning, you keep your head down, you save, and you may monetize your life's work. But with the implementation, or with the advent of COVID, there is no normal anymore. It's just adaptation. There may have been earnings and a savings hit. Maybe valuations have changed a little bit. Terms may have changed. We're in the midst of a second wave. Will there be a third wave? So it's really important that as you put your plan together, your comprehensive plan needs to be integrated. It needs to be meaningful. It needs to be fluid. And so it's not just about retirement income planning. It's about investments. It's about all the other different pieces of this integrated plan. And so when we talk about financial planning, it's really organizing things. If you think about Financial planning is a legal brief. It's taking all the various pieces and putting them together and into a cohesive, beautiful statement, and understanding exactly what's before you and being able to see the end result and being able to put the pieces together. So when we talk about planning and we talk about what's on your bucket list, again, this is different for every individual. It's not just about retirement. It is about a bunch of different objectives throughout. And what's common to all of them, and you're going to hear this throughout today's presentation often, is cash flow. Cash flow is by far the most important thing for you to understand as a professional, both on the business and personal side, and how they're integrated. And the way we approach that here at Nicola is we look at this from a financial planning perspective. We look at, whether it's a gifts to family, whether it's a rec property that you want to purchase, travel, the bucket list items, or even a family legacy. Looking at those things in total as a bigger picture allows us to look at what opportunities are in front of you from a planning perspective. One of the common questions we often get in our planning is, well, how much money can I spend? And when we take a look at the different factors, let's look at an example here, a case example. We have somebody who's got 3 million of investable assets after their practice sale. They've got a 20% average tax rate in retirement. Income results are going to be indexed for tax. We're going to assume some CPP and some OAS, and the returns we're going to look at in terms of the impact of returns on spending are going to be between 2 and 5 after inflation. So let's look at that. What we have is a situation here where if you had a portfolio of 3 million earning that 2%, this is what you'd have after tax income, 3, 4, and 5%. And so what you can see is that 3% more return actually translate into about 100% more in spendable income. Another way to look at this is, what if I needed $180,000 after tax income in retirement? So we look at the same assumptions and we put those together and reverse engineer it and say, well, at 2% rate of return on your portfolio, you need to have nearly $10 million. And then as you start to increase your returns, a 5% rate of return, you need nearly $4 million. So again, 3% more return means you need to have about $6 million less in capital required. So there's different ways of looking at this, but it all comes back to having that comprehensive plan. You need to know your cash flows, both income and expenses, both corporately and personally. You need to set those goals. They're unique goals to you and your family. You need to differentiate between needs and wants. And Rick mentioned that earlier. There are absolute needs and there are wants, and we need to work with you to understand what those are for you. I need to revisit them semi-annually at a minimum. You can't just set it and forget it. And finally, you need to engage an expert who deals with lawyers. And so why is that important? Because we want to put together a tax effective plan. In 2017, when the tax on split income, or TOSI, rules came out, much of the traditional planning may have gone by the wayside. But today, there are still opportunities. It might be capital gains planning. It might be looking at different ways of compensation, retirement planning at different ages, triggering some non-taxable capital dividends in your corporation, the use of an individual pension plan or an IPP, using your corporation. If you're not professionally incorporated, there's something to consider, and using the refundable dividend tax on hand and capital dividend account, the use of prescribed rate loans, flow through shares, or looking at estate freeze and refreeze. And this is by no means a definitive list. There are certainly other opportunities. So let's look at one of the advantages of incorporation. Simply put, you can defer taxes. In this case here, we have an individual who's unincorporated, earns $250,000. Their savings is about $34,000, and that's as a result of paying taxes, and they've got a lifestyle need of $120,000. Well, if they have a lifestyle need of $120,000, if they incorporate, they can pull out a smaller amount of salary, retain some of the income within the corporation, and you can see that the difference is, instead of $34,000 in savings, they have nearly $61,000 in savings. There is an asterisk here, and that is you may have greater net savings, but over time, you've got to be careful about the tax trap. And we're going to talk about that in a few minutes. For now, let's talk about a specific taxation and planning strategy, and this is the use of an IPP, or individual pension plan, or retirement compensation arrangement. This is something that's come back into planning as a result of the TOSI rules being implemented. You can eliminate tax on your large corporate gains. You can look at earlier income splitting, and this is done while funding your own pension. So you have your corporation funding your pension. Think about a much larger RSP. And so, especially when you go to sell your practice, there may be a certain opportunity available to you then. And it really dovetails into wills and estate planning as well. So let's look at some specific advantages with respect to an IPP. It has predictable retirement income. Generally, there's a higher contribution limit than an RSP. You can income split between spouses at any time. And let's compare that to a RIF where you have to wait until you're 65. The participant can buy back years of prior service upon the plan's implementation. So you might be able to receive a higher annuity, and the returns, of course, like an RSP, are tax sheltered. However, in the case of early retirement, the business can supplement with an additional contribution. So it's a direct deduction to your corporation. You have certain advantages there. The contributions are deductible. The setup and administration costs are tax deductible. And the IPP reduces your shareholders' equity, which can help facilitate the sale of the business depending on how you're structuring that sale. If you do have a loan needed to fund the IPP, that's also tax deductible. So we talked here a bit about selling your practice. One tax effective way of looking at that in terms of selling your corporation tax-free is understanding what the value is currently based on. So is your professional corporation based on assets? Is it previous transactions? Is it future cash flow? Is it goodwill? My research is showing that typically, depending on the practice type, it might be current value somewhere between 1/2 to 3 times your earnings before interest, taxes, depreciation, and amortization, or EBITDA. And if you're able to structure it as a share sale rather than asset sale, it might allow you to access a lifetime capital gains exemption. So the first $900,000 of that sale is tax-free. And it's quite important, though, if you are structuring it as a share sale, to understand where your insurance policy is placed. Many individuals, lawyers, will have corporate life insurance policies. That's absolutely the right thing to do. But you got to be careful where you place that, and I'll talk to that in a moment. So why is insurance important? Certainly, insurance is there to mitigate the risk of death, disability, illness, or taxes. But you do need to watch the location of those policies. So your life insurance should be in your professional corporation unless you plan on selling the corporation's shares, because that can create a problem in terms of purifying the corporation. The disability should be held personally, and the critical illness, really, it depends on the situation. But life insurance isn't there just for death or disability or illness or taxes. It can be used, depending on the kind of insurance you have, to fund some of your retirement needs. And it's also important to note that if you are leaving a corporation that might have a health insurance plan in place, that sometimes you can coordinate your existing benefits through a group plan, and it's possible to port some of that life insurance without a medical. So often we will see individuals saying, hey, I'm retiring from practice, but I'd like to maintain some life insurance. And it's possible to do that through your group benefits plan, in many cases, without a medical. So why is cash flow the most important thing? Because it is going to be the single biggest creation of wealth will come from what you do daily. It's your ongoing cash generation, and it may be a part of your retirement in terms of monetizing the value of your practice. And again, it's not how much you keep. Sorry, it is how much you keep. It's not how much you make. So capital preservation is the key to keeping and growing your money and avoiding the tax trap. AAII is adjusted aggregate investment income. And I mentioned that earlier. When you're saving in your corporation, it's important to ensure that you don't save too much in there. Otherwise, it's going to grind down your small business deduction. So let's look at what that means. There is active income and passive income tax rates. And in your corporation, active income is what you do on a regular basis. Passive income will come from the investments. And so what ends up happening is as your investment earnings grow, any investment income, passive income from 0 to 50,000 is fine. But once you start to get over 50,000, you start to grind down your small business deduction. And let's look at an example of how that plays out and how it impacts you. So here's a situation where currently an individual is earning $50,000 of passive income in corporation. No issue, they're within their limits. Tax would be roughly half, 25,000. If all of a sudden they made 60,000, the tax on that is going to be 30,000. And in addition, they'll have a loss of a small business deduction of 50,000, which translates in an additional 7,500 in their corporation. So what ended up effectively happening was you got $10,000 of new passive income. That's at 50 to 60. But in total, both corporately and personally, now you're paying 12,500. So you're actually paying more than you would have earned. And so that's why it's really important to look at that, because in this case here, you're paying 125% of new passive income. And if passive income, rises from 50 to 150, or an increase of 100,000, your corporate taxes are going to rise by 125. So it's quite important to be aware, not just of the passive income rules or the rates, but it's important to be aware of how your portfolio is structured, because different structures of the portfolio will create different types of income. So when we talk about portfolio construction, typically, you might have a 60-40, you might have 50-50, 70-30, and that might have been the old way of doing things. We would question whether it was really ever the right model, because when you start looking at asset allocation for high net worth investors around the world, what you're going to see in the next few slides is some of the commonalities are that they're not just investing in publicly traded stocks and publicly traded bonds. They're going to have asset allocations to different kinds of investments, whether they're alternative or real estate. If you look at this Capgemini report for 2020, you can see, again, allocations to different types of investments beyond the traditional publicly traded stocks and bonds. And that's how institutional money and pensions invest. The Canada Pension Plan does that. Whether you start to look at other investment scenarios like OMERS, which is the Ontario Municipal Employee Retirement Pension, you look at the teacher's pension. And again, you're going to see different types of asset classes, whether it's the Harvard Endowment, CalPERS, which is the California Pension Fund. All of them are going to have different types of asset allocation beyond the traditional stocks and bonds. And so what do we do at Nicola, and how do we do it? We do it very similarly. This is our asset mix here as of December 31, 2020 for our typical client. And you can see we have allocations to real estate, private equity, private debt, alternative strategies, and our total exposure to publicly traded equities is about 25%. And we have other types of fixed income assets, including private mortgages. Now, why is that important? Because when you look at a recent study in 2017 of what the world was worth, the total real estate assets in the world was about $218 trillion, which is significantly more than publicly traded equities and is significantly much more than any fixed income. So we believe that the global investment allocation, when you start to look at the pie for real estate, 20% of it is commercial, 11% is, 20% is multifamily, 11% commercial, some is farm and timber. And then when you start to look at public equities and securitized debt, and there's a small allocation of gold, 42% of global investable assets are going to be in this private sector. So our question is, why would these other ones here on the left-hand side, why would they be 60 to 75% of your investment portfolio? And we talked about taxes a few minutes earlier and knowing your asset allocation. I'm going to share with you what our core allocation looked like at December 2019. And what you can see out of this is about 60% then was in publicly traded securities and about 43% in private. And if you look just at the private assets, this is how it was allocated. With, again, these asset classes, mortgages, private debt, these are taxable. We want to put those in your RSP, your IPP, your TFSA, and foundations. Whereas you look at the private assets, they tend to be less taxation attracted to them. So let's look at a result of over 5 years of what that means to an individual with a corporation. So if you had $1 million during that period of time, over time you had generated 658,000 rate of return before fees. Your taxable income was only about 156,000, and in fact, tax paid was only about 10,000. Now, how is that possible? That over those 5 years you had a gross return of about 10.7, net return after fees and after taxes of about 9.6. That's possible because the RDTOH, refundable dividend tax on hand, reduces your corporate taxes by 60%. You're going to have low turnover of assets when it comes to private assets. There's going to be depreciation in the real estate, which creates a return of capital, which is just not taxable. And of course, your planning fees are deductible. So this is if you just had private assets. What if you were to overlay that and add to it some fixed income component? Well, in that scenario, again, there's that million, but this time you only had 579,000. Again, fixed income is going to generate less of a return. Your taxable income was a little bit less, 116,000. And in fact, tax payable during that 5 years would have been zero. And again, how is that possible? Simple, because at this point here, you're putting your interest income into your registered plans, your IPPs, your RSPs, and so forth.
Hey, Ron, if I can just interject at this point. So just to let everyone know, we're already at the halfway point. So if you have questions, please ask. Ron, I just wanted to get you to clarify one point. So we're going into a lot of these key details, but can you just clarify that from a Nicola standpoint, we do the initial planning, come up with the strategy, and then after all that thinking and strategizing is done, which you sort through with the client, then after that, then you're just working the plan. So I just want to make clear to people that there's some work up front to sort out the strategy. But once we get rolling, we realize that professionals are busy people, that, we put the plan in place and then we're doing that reporting. But you can rest assured the details are taken care of.
Yes, Rick, thank you. And I think maybe to build on that, we often talk about in our industry, past returns are not indicative of future results, and we can't guarantee returns. I do have a colleague who often says, if I can save you through good planning, money on taxes, that is a guaranteed return. So if we're able to work with you and highlight some opportunities for you to save money on your taxes in corporately or personally by integrating them into a flexible and dynamic fluid plan, we are able then to add significant value. And so I think that is a critical key of what we do, Rick. You're right, is the planning first, and we focus on the planning before we even talk investments. So when we do talk about planning, it is cash flow. It is cash flow focused. We need to understand all that. Why is cash flow important, not just from a planning perspective, but why is it important from an investment perspective? Cash flow provides an automatic reinvestment tool to ensure that you're buying assets at the best of time in downturns. So if you think back to March of last year, markets were down, 35%. How many people were calling up and saying, hey, take more of my money so we can invest it in a down market? If you're fully invested and you have cash flow coming off your portfolio of about 4.5%, you can reinvest that as the market provides you with opportunities. Cash flow also is less volatile than the underlying asset prices, so it removes the emotion again. If we know that through dividends and rents and interest, we're going to be able to generate that 4.5%, we're not having to, in order to achieve your rate of return, we're not going to have to worry about price appreciation if you're just counting on the stock market. It also meets your lifestyle needs. So if you retired in February of 2020 and you put everything in, you didn't have to worry about what the market was doing if you had that cash flow coming to you. And then finally, it does smooth out the return on more volatile assets. It's quite important to be able to look at that opportunity. And I'm going to show you a specific example of where that makes a difference. With us at Nicola, we have two planners who review the portfolio asset weights to strategically rebalance. It's reviewed at least every 90 days, and its targets are customized based on each client profile and plan. So to Rick's point earlier, do the planning, understand the client scenario, see where we can save on taxes, then we invest strategically in an appropriate fashion, and we continue to monitor and implement that. So this is available on our public website, and you can see that from the period of 2000 when we started this iteration, we're close to 7% after all fees. I believe we're one of the few firms that puts all our results, net of all fees, on our public website. And so that does beat every index that you see here, whether it's the S&P 500, either in Canadian or US dollar terms, or world index, or a typical balanced mutual fund. We're able to certainly outperform. But the key is, how did we do this? It was through cash flow, and it was through prudent planning, and it's through not losing money, quite frankly, for clients. When you start to look at our years over the period of time, you can see that during that period of time, we only had one major drawdown in 2008, and relative to the market, which was down about 50%, we certainly outperformed, and relative to a balanced mutual fund, we outperformed. But in years when the market does move, you can see in 2009, 2010, we still participate in the upside. So it's by winning with defense, it's by not having significant drawdowns on your capital, that we can implement a preservation first mentality. You've worked hard to get to where you are, and it's about ensuring that we don't give any of it away. There was a great Morgan Stanley advertisement back in the 90s, I think it was. It said everyone's got to pay their taxes, but there's no law that says you got to leave a tip behind. And so that's our approach, is not to pay more than you need to in terms of your fair share. So in conclusion, one of the things we want to talk to you about today is use the same principles you tell your clients to adhere to as professionals. Use the professional advisors with expertise in this area, do your homework, bring that support team together, and be what I call the 40-year overnight success.
Mhm.
Again, the work that you do every day is what's going to translate into your financial independence. So as we end today's presentation and open it up to questions, we'll leave you with a few items. Have you anticipated what speed bumps can impact your cash flow? So this is the important one in terms of, again, ensuring that you understand what's going to happen on a go-forward basis. Do financial concerns ever hamper your effectiveness? So, are you solely focused on your practice, or do you have thoughts that sometimes derail your practice because you're thinking about other items from a financial perspective? And then maybe lastly, are you convinced you're getting the best advice for yourself? So with that, we'll open it up to questions.
Yeah, that's great, Ron. And as I mentioned, we'll have time to handle some questions. I have a few questions here. Here's an interesting one. So what is the single biggest financial planning mistake that lawyers make? Like, based on your experience, what do you see too many times, something that can be prevented?
Great question. The single biggest mistake I've seen lawyers make, and it's not just lawyers, it's most professionals, is the failure to integrate both the personal and corporate planning. They see, here's my RSP, here's my TFSA, here's my non-registered savings, and then they see their corporation over here. And they fail to integrate the two in terms of compensation. Should I be paying myself a salary, a dividend, combination of both? How do I withdraw out of the corporation? How do I save within the corporation? I showed you that brief example about saving within your corporation, how it could impact you. So I would say that's probably the biggest mistake we've seen.
Right. And then I have another question here. So, of course, people are at different stages of their career. As you indicated, there's that career cycle for lawyers. So there's a question regarding, well, what if it's a lawyer, in his or her, say, late 50s, early 60s, and maybe he hasn't done really great planning up till now? What are some things where that person can, in a sense, make up for lost time and salvage their financial planning situation through some key tactics?
Good question. So let's assume you're even retired. You're not even approaching retirement. Are there strategies you can take advantage of now? And the answer is yes. Depending on what your goals are. So certainly the use of donations. You can look at flow through shares. Income splitting with your spouse is still an option. And then maybe finally, or just as important, is sound portfolio construction, just to reduce the tax drag. I showed you that example earlier where, what it would look like in terms of having the right assets in the right buckets. Not only does it reduce the volatility if you have the right assets, structuring in the right way can reduce the tax drag on your portfolio and just keep
Right.
more in your pocket.
Right. And then I have another question here. It's regarding safe havens for investing. So, of course, as we know, people work really hard for their money. The idea is we're not losing it, we're actually making it grow. But are there some safe havens where I don't have to worry about, my hard-earned money? I'm going to lose $500,000 in a matter of weeks. Like, what would you say this to that type of question?
Um, Two things, I think. One is the best investment is always going to be your legal practice. But that also dovetails into the second answer, which is, our love of private assets. Your legal practice is a private assets. We love private assets. They provide a stable cash flow. It's not tied into the public equity markets. And if you're retired, you want to rely on that cash flow, not the ups and downs of the market. If you start to think about, during your career, you have a cash flow coming in, and if the markets are going up or down, you're not as concerned. Why not structure your investment portfolio in the same way? You're retired, you don't have that practice providing you that cash flow. You should
Mhm.
structure your assets in the same way and to ensure that you have that stable cash flow. So,
Right.
not that you don't want to participate in the public markets, you just don't want to be reliant on them in this scenario.
Right, great. So I have a question that came in regarding, it's a bit of a different direction. So this question regards income splitting. So can you speak to income splitting with your spouse if you are under age 65? So maybe just recap some of the key points about the income splitting. And I know Nathan, who posed the question, he's well under 65.
So generally speaking, you can split your pension income, RIF, CPP. You can split your pension income, your private pension income with a spouse in the general scenario. What I was referring to was an individual pension plan. When you do your own IPP or your own funded pension plan, you can income split at an earlier age, as early as 55. And so often what we'll see is scenarios where um, couples are income splitting if they're retired earlier. So if you're an individual who is fortunate enough to work hard and save and structure an IPP, you're able to income split much sooner, which again, it's about reducing the family tax bill. It's not about, you know, um, uh, paying more in taxes than you need to. It's just about reducing that family tax bill. So that's certainly available to you if you have an IPP, and is something we'd be happy to talk to someone about.
Great. So I think we've answered everyone's questions. I'll just point out quickly, if anybody else has a question, just pose it quickly because we'll be wrapping up shortly. But Ron, I was hoping you could just drive home this one point. So for people listening, can you just clarify again the inter the interaction? Oh, sorry, their question just came in. It's related to income splitting. So I'll just pose this one. Could the income splitting question be about TOSI and income splitting with spouses under ages 65?
Okay, so prior to TOSI, tax on split income, prior to 2017, many people were paying dividends to family members. It was an easy way of income splitting. The Liberal government, when they rolled out their platform, tax on split income, put the kibosh on many of those opportunities. And just to maybe simplify it, today there aren't as many opportunities in order to be able to dividend out of your corporation to a family member, unless there are specific criterion that's being met. So certainly you can look at different structures like an IPP in order to accomplish some of the tax on split income.
Right. Okay. Well, thanks for addressing that. So I was just going to ask you to maybe drive home the point about the interaction between the financial strategizing and the management of funds. So again, in terms of a next step, just to talk about how important it is to have a customized approach, for us to really understand the person. That's the foundation. Then separately, there's how you'd actually invest and what you'd invest in. So maybe just by way of summing up, maybe just clarify and emphasize a few of those points.
Okay. Um, what we do at Nicola, I think, is again very different. We have a 99% client retention rate over 20 years, and I think part of the reason is that we believe in full disclosure, full transparency. Hence, everything is on our public website. But we believe in try it before you buy it in many ways. So clients or prospective clients who are interested in working with us would reach out to someone like yourself or myself. We would have an exchange of information. We would put together a customized plan based on their unique circumstances. We would put together a customized investment recommendation, again, based on that plan. We would then meet with them, and in today's environment, we'd meet virtually like this with them. We would present that plan, and we would start to look at different opportunities and options available to them. So before they've even become a client, they're getting a significant look through into what it would be like to be a client. And it's really important for us to have that, because then we have a meeting of the minds. If they understand the work we're going to be doing for them, we tend to end up having lifelong relationships. And it is about trust. If I'm coming to a legal practitioner, it's typically from a referral. 80% of our new clients are coming through referrals. So I would come to that legal practitioner, I would share with them my current situation. They would assemble their team. They might present some prospective options, and then we would engage them as our professional legal team. And it's very much the same here on our end.
Great. Well, that's a great summary. And I'd like to thank you for your presentation. It was great as usual. And I'd like to thank all of you for listening and participating in this webinar. At this time, I'd like to thank you for attending on behalf of our support team, Ron and myself. And if you have any questions, of course, you can contact Ron and myself. Our information is available via our Nicola site. And I hope you have a good rest of the day. Thank you very much.
Thank you, everybody.